If you invest in enough real estate syndications, eventually one of them is going to underperform. Not because you made a bad decision. Because real estate investing involves real risk, market shifts, renovation overruns, occupancy surprises, interest rate moves. No underwriting model is perfect. The question is not whether a deal ever misses its projections. The question is, what does your GP do when it does? In this video I'm going to walk you through exactly what good GP behavior looks like when a deal underperforms, and what the red flags are that should have you asking harder questions. As a passive investor, you need to know the difference. Here's the thing most passive investors don't realize until it's too late. The risk in a syndication isn't just the deal. It's the GP. A well-capitalized deal with disciplined management and a communicative GP can navigate a difficult period and recover. A solid deal with a GP who goes quiet, deflects, or misrepresents what's happening can turn a manageable problem into a permanent loss. What I'm going to give you today is a framework for evaluating GP behavior specifically during adversity. Because that's when you find out who you're actually in business with. Let's start with what good GPs do. There are 5 behaviors that signal you have a trustworthy operator when performance misses. Number 1, they communicate before you ask. The first signal of a trustworthy GP in a down period, you hear from them before you go looking for information. A good GP sends the monthly update, on time, with the real numbers, even when the numbers are bad. They don't wait for a quarterly cycle to disclose a bad month. They don't let you find out from a co-investor who heard something. If you've had to send an email asking how the deal is going, that's a yellow flag. If you found out something was wrong from a source other than your GP, that's a red flag. Number 2, they're specific about what happened. The market got soft is not an explanation. It's a deflection. A good GP tells you specifically what changed and why. Which expense category ran over and by how much? What occupancy did and what drove the vacancy? Whether the renovation came in on budget or not, and if not, what the gap was. Specificity is respect. It's also diagnostic. A GP who can explain what happened clearly is a GP who understands their own asset. One who gives you vague market references may not. Number 3, they separate facts from projections. Good GPs are clear about what they know and what they expect. Here's what happened this period is a fact statement. Here's what we think happens over the next 90 days is a projection. These are different conversations and they should not be blended. A GP who blurs the line, who presents a recovery projection with the same confidence as a known fact, is either not tracking the distinction themselves or hoping you won't. Ask directly, is that what happened, or what you expect to happen? Number 4, they tell you what they're doing about it. Not, we're monitoring the situation. Specific actions. New property management firm. Capital reserve being deployed. Lease-up strategy adjustment. Refinance being explored to extend the hold. Sale being evaluated. A GP who is actively managing through a problem knows what the specific interventions are. If the answer to, what are you doing about it, is vague reassurance, the problem may be that they don't know. Number 5, they hold the communication cadence. This one is subtle but important. After a bad quarter, the instinct for some GPs is to go quiet, wait until there's better news before reaching out again. That silence is often more alarming than the original miss. A good GP holds the same communication cadence through difficult periods that they hold during good ones. Monthly updates go out on time. They're honest. They don't get shorter just because there's less good to say. If your GP's update frequency changes after performance misses, pay attention to that pattern. Now let me be specific about the warning signs. These aren't reasons to panic, but they are reasons to ask harder questions. Red flag 1, updates that disappear. You were getting monthly updates. After a rough quarter, they stop, or become quarterly. Or they shift from a regular cadence to, we'll be in touch soon. Reduced communication frequency after a performance miss is one of the clearest warning signs. Red flag 2, explanations that blame the market exclusively. Markets do affect performance. But if every explanation is the macro environment with nothing specific about what happened at the asset level, the GP may not be managing proactively, or may not want you to know the real drivers. Red flag 3, projected returns that keep shifting without explanation. A revised projection is normal, markets change. What's not normal is revisions that happen without a clear explanation of what changed and why. If the target returns get revised down multiple times without a coherent narrative, ask for the updated underwriting model. Red flag 4, reluctance to get on a call. A GP who will only communicate by email when you want to talk, especially after a miss, is often managing information, not the asset. Request a call. If it's consistently deflected, that's a significant concern. Red flag 5, we're working on it, without specifics. This is the vague reassurance response. It signals one of two things: the GP doesn't have a specific plan, or they don't want to disclose it. Either is a problem. Push for specifics. What are you doing? What's the timeline? What triggers a change in approach? If you're seeing yellow or red flags, here's what to do, in order. Step 1, document what you're observing. Keep a simple log of update frequency, what was said, what you asked, what response you got. If things escalate, that documentation matters. Step 2, send a direct, professional email requesting a call. Not accusatory. Factual, I'd like to schedule a 20-minute call to get an update on the asset, specifically the issue you mentioned in your current plan. Can we find time this week? Step 3, on the call, ask the specific questions. What is the current occupancy and NOI versus plan? What are the specific actions you're taking? What's the current outlook for distributions? What scenarios are you evaluating, including sale or restructuring? Step 4, know your rights under the operating agreement. Read the OA before you need it. Know what reporting you're entitled to, what LP consent is required for material decisions, and whether there's a removal mechanism for the GP. Understanding these rights is not adversarial, it's due diligence. Step 5, if communication breaks down, seek counsel. If a GP is unresponsive to reasonable requests for information, an attorney who specializes in real estate syndications can advise on your options. This is a last resort, but it's not an extreme one. Your capital is at stake. The best time to evaluate all of this is before you invest, not during a problem. When you're doing due diligence on a GP, ask directly, tell me about a deal that didn't go as planned. What happened, and how did you handle it with your LPs? A GP who has been through a difficult period and managed it well will have a clear, specific answer. They'll tell you what happened, what they communicated, what decisions they made, and what the outcome was. A GP who has never had a deal underperform is either very new or not being honest. The answer to that question tells you more about who you're investing with than any projected return schedule. Here's the summary. When a deal underperforms, a trustworthy GP communicates early, explains specifically, separates facts from projections, tells you what actions they're taking, and holds the same cadence they always have. Red flags, disappearing updates, vague market blame, shifting projections without explanation, reluctance to take a call, vague reassurance without specifics. If you're concerned, document, request a call, ask the specific questions, know your rights in the operating agreement, and seek counsel if communication breaks down. And before you invest, ask the adversity question. It's the most revealing question in LP due diligence. The LP due diligence checklist, including the red flags section and the adversity question, is linked in the description. Subscribe if you got value from this. Next video covers the refinancing decision, when GPs pull cash out versus hold for sale, how that affects LP returns, and what to ask before you agree to a refi. Thanks for watching.